Well, welcome back. Big day for markets today. We've got the jobs report for the month of September out later this morning. Take a look at futures. Ahead of the numbers, we're expecting a lower opening for stock prices today, down about 50 points on the Dow Jones Industrial Average. The economists are looking for 175,000 new jobs to have been added to the economy last month, with the unemployment rate holding steady at 4.9%. Joining us right now, our friend Stephanie Pomboy, MacroMavens President. Stephanie, good to see you. I know you're right in there as far as the expectations. You think, sure, we could see 170, 175, but you don't think it matters very much.
No, I give up trying to forecast these numbers. You know, the payroll employment report is among the least reliable indicators, and that's saying something because most of them are pretty bad. You know, their confidence, they write themselves, their confidence interval is plus or minus 115,000, and here we're talking about 150, 175. Right. So it's really kind of a silly exercise. But
so what's most important when you look at the economy right now?
Well, I think, you know, as we look at employment, we have to look at the number one input into hiring, which is profit growth. It always has been. If you do an overlay of year-on-year profit growth with employment, it's hard to tell the lines apart. It always has been that way, except twice right now, and then in the great malinvestment bubble leading up to 2000, where you had excess capacity and investment that ultimately was corrected pretty severely. So right now we're kind of, you know, the roadrunner off the precipice in terms of employment growth kind of staying stable while profits implode. And I think the employment shoe is going to drop.
Well, I think today the most important thing that could come out of this report is the wage growth. If we see a disappointing wage growth number, I think that'll spook the markets. We know, and we saw a couple days ago, the ISM non-manufacturing, which is really just encompassing our services economy. We look at the sub-index, employment was up 6.5 points. Right. So that gave a good read-through for today on the actual jobs number. But if wage growth isn't up, I think that's going to be a big issue heading into actually a December hike potentially by the Fed.
And that's been the story all along. You know, we've had decent employment growth, but the wage story has been really disappointing. And I think the ultimate arbiter of that is individual income tax payments. I mean, we can try to look at different measures of wage growth, but the last word on it is what people are paying in taxes, and that's growing zero.
Wow.
Year on year. So it's gone from, you know, plus around 4% to zero. So that doesn't support the idea that we're producing any quality jobs with real wage income. And I'd also note that the last time the unemployment rate was at 4.9 as it is today, average hourly earnings were 4%. Today they're 2.5. So clearly the surface impression of solid job growth is not supported by the details there.
With the wage increases, though, that you are seeing, the minimum wage increases by the private employers like a Walmart, a Target, a lot of them, will we continue to see trickle through from that, though?
I mean, I guess. You know, it's just, I don't know. It's ultimately, I guess the question is, can they absorb those wage increases? Is it working for them from a profit standpoint? I mean, I don't see companies running out to increase wages if their top-line revenues start to slow. And that, of course, is something I've been very concerned about.
I think you're bringing up a great point. Companies are really focused on margin expansion as opposed to top-line growth, because if we go back to last October and we see the GDP prints, they're actually around 1%, which is really disconcerting. And CEOs are looking at that, and you saw the CEO roundtable came out earlier this week, and they're saying, hey, we think we're going to have really no growth. And so that's how they're focused, spending the money.
Well, you're tapping into profit growth, and that's going to dictate investment spending. That's going to dictate hiring plans. That's going to dictate everything. So I understand why you're looking at profits as the real indicator here. And it doesn't look good. Do you think we're going to go into a recession in 2017?
I do. I mean,
you do.
We've never had a profits recession without an economic recession except once in 1986. I mean, and that's going back, you know, 60 years. And I think the reason why no one talks about it now is there's this kind of cavalier attitude that the profits recession isn't really a typical recession. It's just lagged effects from the dollar and oil. But in fact, you know, GDP growth, this whole idea of a second half recovery on stronger consumption, that's taking on water every day. I mean, the Atlanta Fed has taken its nowcast from 3.8 to 2.2, you know, and the slow march down continues.
And estimates keep going down,
yes.
actually. We've been talking about that all week. John Hilsenrath brought that up. The economists are taking estimates down rest of the year. Okay, real quick on the British pound, 31-year low. Why is this important?
Down 17% because it's going to affect, it could affect our GDP growth because goods and services are going to be flowing out of a free market economy, and their taxes are lower. So you've got companies out there spending in the UK.
The currency story important?
I'm not really.
Does that play into the
from the employment standpoint?
Yeah.
I don't really see that as a huge factor. I mean, trade really hasn't been that important for the U.S. economy.
Stephanie, thanks for joining us. Appreciate it very much. Stephanie Pomboy.